You ever see a new mutual fund pop up and wonder what's really inside it? Well, today we're going to do exactly that. We've got our hands on the official document for the brand new Invesco BSE Sensex Index Fund, and we're going to break it down together. Let's see how it works, straight from the source. So just think about this for a sec. Let's say you wanted to own a piece of India's 30 biggest and most important companies. Buying each one of those stocks individually? Ugh, that sounds like a massive headache, right? So there's got to be an easier way to get a slice of the whole top tier of the market, all in one go. And that's exactly what this new fund from Invesco is offering. But to see if it holds up, we're going straight to the horse's mouth, the official scheme information document. You can think of this thing as the fund's instruction manual, and we're about to read it cover to cover. Okay, so let's start with the absolute basics. What exactly is this thing we're looking at? Well, at its very core, it's designed to be a super simple way for you to own a piece of the entire stock market. The key term here is index fund. Now, you might be used to hearing about fund managers who are actively trying to pick winning stocks to beat the market. This is the total opposite of that. An index fund has just one job: to copy a market index to mirror its performance exactly. In this case, that index is the BSE Sensex. The best way to picture it is like this. Instead of you having to go out and buy shares in 30 different companies one by one, you're just buying a single pre-made basket that already has all of them inside. It's simple, it's efficient, and it's diversified from the get-go. All right, so we get that it's a basket of stocks, but what's the actual goal here? Every single fund has an official investment objective, which is basically its mission statement. So let's see what this one promises to do with your money. And here we have it, the exact language pulled from the document. The two phrases to focus on are passive investments and replicating the composition. That's just a formal way of saying its job is to copy the Sensex. But, and this is important, notice that little phrase at the end, subject to tracking errors. That's them being transparent. They're admitting it can never be a 100% perfect match because of things like fees. The goal is just to keep that difference as tiny as possible. So let's boil it all down. The fund manager here isn't trying to be some stock-picking superstar. The goal is not to beat the market. The goal is to be the market. It's designed to give you whatever performance the BSE Sensex gives, good or bad, minus some small fees. It's a game of mirroring, not outsmarting. So, we know what it is and what it's trying to do. But what's it actually made of? Time to pop the hood and see how this thing is put together. The document makes this crystal clear. As you can see, between 95 and 100% of the fund's money will always be in the stocks that make up the Sensex. That little sliver of 0 to 5% for debt and money market instruments, that's basically just some spare cash the fund keeps on hand for day-to-day stuff, like paying investors who decide to sell. You know, what's almost as important is what this fund is not allowed to do. The rulebook is super strict. No foreign stocks, no weird, complicated debt products, and absolutely no speculative moves like short selling. The whole idea is to keep it simple and just stick to the Sensex, period. All right, let's talk about the big one, the question on every investor's mind: risk. How safe is my money going to be in something like this? Let's dig into what the official document has to say. So yeah, what's the official verdict? Every fund has to have something called a riskometer. Let's take a look. And there it is. The regulator-mandated riskometer is cranked all the way up to very high. Now, I know that can look pretty scary at first glance, but there's a really simple reason for it. See, that very high rating isn't because the fund is doing anything reckless or unusual. It's because its entire job is to hold stocks. And stocks, just by their very nature, are considered a high-risk investment. That meter is just reflecting the natural ups and downs, the volatility of the stock market itself. Okay, let's get down to the nitty-gritty. We've talked about the what, the why, and the how. Now let's cover the practical details you'd need to know if you were actually thinking about investing. First step, the dates. Because this is a brand new fund, it has a special launch period called the New Fund Offer, or NFO. That's your first chance to get in, and it runs from April 23rd to May 7th. After that window closes, it'll open back up for business as usual, where you can buy and sell anytime. So, what's the barrier to entry? How much do you need to get started? Just 100 rupees. That's it. And that's not just a one-time thing. Anytime you want to add more money, the minimum is still just 100 rupees. So it's pretty clear they want to make this accessible to pretty much everyone. Okay, now this next part is a really big deal. What if you invest and then you need your money back? Well, check this out. The exit load is 0. That means no fees, no penalties for selling your units whenever you want. That kind of flexibility is a huge win for an investor. So, if we put all the pieces together, what have we got? We're looking at a super straightforward passive fund that just wants to track the Sensex. It's incredibly accessible with a tiny minimum investment, and it's really flexible because there are no fees if you decide to leave. And that really brings us to the final and most important question. We've unpacked the what and the how directly from the fund's own rulebook. But the question that only you can answer is this. Is a passive strategy like this, just owning a piece of the biggest companies, the right move for your own personal financial journey?